Hi everyone, my name is Victor Coronado, Associate Vice President here at K Properties. I want to thank everyone for joining us on this 1031 Exchange DST investment conference call. We'll begin with risks and disclosures. DST 1031 properties are only available to accredited investors, generally described as having a net worth of over $1 million, exclusive of primary residence, and accredited entities only, generally described as an entity owned entirely by accredited individuals and/or an entity with gross assets of greater than $5 million. If you are unsure if you're an accredited investor and/or an accredited entity, please verify with your CPA and attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, and/or real estate. Such offers are only made through a private placement memorandum, PPM, which is solely available to accredited investors and accredited entities. Securities are offered through FINIX, member FINRA, and CIFIC. FINIX and K Properties are separate entities. This material is not to be interpreted as tax or legal advice. Please speak with your own tax and legal advisors for advice, guidance regarding your particular situation. There are risks associated with investing in real estate and Delaware Statutory Trust properties, including but not limited to loss of entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read the PPM carefully before investing, paying special attention to the risk section. Because investor situations and objectives vary, this information is not intended to indicate suitability for any particular investor. Please speak with your CPA and attorney to determine if an investment in real estate or DST properties is suitable for your particular situation or circumstance. Past performance is not indicative of future returns. Potential cash flows, returns, and appreciation are not guaranteed and could be lower than anticipated. Thank you, everyone, for listening in. And now I turn the call over to our Vice President, Keith Cawley, here with K Properties and Investments.
Hi, everyone, and thank you so much for joining us today for DST Essentials with K Properties. We do host these calls each Friday to take a deeper dive into the various themes and nuances to the DST investment process. So before we do introduce our guests today, I'm going to discuss a little bit about K Properties. K Properties is a national Delaware Statutory Trust, DST investment firm. The www.kpi1031.com platform provides access to the DST marketplace of over 25 different sponsor companies. This includes custom DSTs only available to K clients and an active DST secondary market listing. K Properties team members collectively have over 130 years of real estate experience, are all licensed in 50 states, and have participated in over $30 billion of DST 1031 investments. So I'm extremely excited to have our own Chay Lapin on the call today. Chay is the president based out of our headquarters in Los Angeles. Chay is a leader and specialist in the 1031 DST space and has participated in over $15 billion worth of real estate offerings. Additionally, Chay has sponsored and co-sponsored the syndication of over 2 million square feet of DST properties in the multifamily, net lease, industrial, and office sectors. So today we're going to take a deep dive into 2 debt-free multi-tenant DST offerings along with a cash investment opportunity. And so Chay, welcome to the call and thank you for being with us.
Yeah, absolutely. And we appreciate everybody joining us on these. And as Keith mentioned, we try to continue to offer educational opportunities every Friday and also on Wednesdays with webinars. And today is unique because we are going to be diving into a few potential opportunities. I do like to always mention, these may or may not be the right fit for everybody, but what we tried to do here is just to highlight various potential investment opportunities, but encourage you to reach out to a K Properties team member to dive deeper because we're really here to highlight particular deals and the way that we structured them. And then would love to have an opportunity to continue to dive in them and see if they might make sense in a portfolio. As Keith said, we're going to dive into 2 DSTs and one kind of fund structure that is just available for cash investments. But I always do like to remind people all DSTs are also available for cash investments. So we have from time to time, maybe someone's exchange, you're coming up on a 1031 exchange maybe or planning, you might not be executing that exchange for another 6 months, a year, 2 years from now. We have a lot of clients that reach out to us well ahead of their exchange and are just preparing. And so, if you had the ability and capital, it could make sense to do a test investment, do, $25,000, $50,000, $100,000 into a DST, and, just see how you like it. So that way, when you come up on your 1031 exchange down the line, that might be a much larger piece of your net worth. You've had a little experience within the structure and the process. So again, everything's available for cash investments. Not everything's available for 1031s, but all DSTs are structured for 1031 exchanges. And so for the first property that we're going to dive into is and really both of these are debt-free. Both the properties that we're diving into are debt-free DSTs. And our goal here, these are created by one of our sister companies, Cove Capital. And the goal of Cove Capital is creating protection of principal primarily through being debt-free and not having that catastrophic loss from a lender foreclosure or catastrophic issues that lenders can cause or force a situation where you might have to fire sell an asset. And that could be through triggers in a loan document, cash flow sweeps in loan documents, a loan coming due at the wrong time. Like right now, you probably wouldn't want a loan coming due because if you had to refinance, it would hit your cash flow. And a lot of banks might not refinance you because of where the environment is currently at. And so we create at Cove Capital debt-free DSTs to give ourselves staying power, to give ourselves flexibility in good times and flexibility in bad times. And so there's pros and cons to every offering, but our biggest goal here is to protect the principal and have staying power, and that ultimately is primarily done by staying debt-free. So the first debt-free asset that we're going to discuss is Cove Eastwood Village Opportunity 71 DST. This is an opportunity at the shopping center in Birmingham, Alabama. It's very interesting because it's the #1 retail center in the market in Birmingham. It's on one of the main thoroughfares of traffic, and they, at this center and at this village that our real estate sits on, there's over 3.4 million annual visits. And for those of you that are not familiar, that's a lot of visits for a retail center. This is what we believe a Class A shopping center, and very unique to the demographic, to the city, to the immediate thoroughfare. And whenever you're dealing with retail, it's very important that you have access to consumers. It's very important that you have traffic count, visitation, supporting tenants, complementing tenants in your center and your surrounding, maybe other real estate, your neighboring real estate is supporting of what you might have on your piece of real estate. And so this is what we believe, this whole little thoroughfare, kind of recession-resistant retail, discount retail. So historically, it's done very well. Obviously, there's no guarantees. There could be issues with tenants, but these types of tenants, these discount retailers, have done well through situations like 2008, through COVID, through times of today where things are getting more difficult for a consumer. And so this center has over 1.9 million square feet of retail. It's multi-tenant, which we do like because it has over 2.3 million square feet of retail in this little village area. And so we like that multi-tenant because it creates a staggered lease situation. So we don't have, all of our tenants' leases coming due at the same time. It gives ability and cushion, God forbid, a tenant decides not to renew at a location. It insulates and creates still a durable income stream potential for our investors. The other important thing on an asset like this is the way we buy it. And we bought this well below replacement cost. So our basis going in is very unique. And this was a situation where we believe there was a seller that had a loan coming due. They had owned it, enough to where they were in a good position to exit, but they were exiting at the wrong time, in a market where there was historically high interest rate hikes. And so this was a good time to be a buyer of an asset like this versus if you were selling this asset a couple years ago, it might have been a much better outcome for the seller of this asset. And through the process of us doing our due diligence, buying this asset, and making it available, there were multiple leases being negotiated, extended with current tenants, which gave us more and more confidence as we were buying the assets. There has been lease negotiations taking place as of today. And our goal with an asset like this, or any asset that has staggered leases, high demand, is to do early extensions, to work with our tenants. We are unique in the DST structure that we, as we're acquiring a property, as a sponsor, as Cove, we are getting in and looking at what are we going to need to do to get these rents to market rent. We believe that a lot of tenants here are below market rents. And what do we need to do? What kind of capital do we need to continue to improve this location? Real estate is living and breathing. You have to constantly, just like any of you on the call or the podcast that own single-family homes or multifamily, to keep your value, you invest money into your property and you get a return on that investment. And that's real estate, 101. Continuing to keep that property as a Class A, #1 visited shopping center, and that's what we plan for. That's our goal. There are always, uncontrollables that could pop up in a market and an economy, but our goal is to look at a 5+ year horizon and look at all the tenants that we're going to try to renew and what could we do? What could we do for those tenants to maintain that relationship with the national tenant, to be the best landlord for them, because that's very important when you're dealing with any piece of real estate, is keeping the relationship, keeping the property in a good position so that they continue to be the #1 retail center in Birmingham. And so, day one, when we take over an asset, we're getting in there. Our team at Cove Capital has already been, upgrading various things across the center, cleaning up parking lots, improving lighting, pressure washing, talking with all the tenants. What do they need? We have a few tenants that are already in these talks of getting early extensions on the lease. And as you guys know, there's a couple things that create value in any piece of real estate. It's that underlying tenant, the quality of that tenant, and what their rent is, and then also what is their lease. And so as we extend leases, get longer terms, get more attractive leases, and that could be from negotiating, triple net leases to make more expense burden on the tenant where appropriate, which obviously falls to the bottom line of the net operating income. And then in commercial real estate, as you get longer, if you can convert a 1-year lease, a 2-year lease to a 5-year, a 7-year, a 10-year lease, that brings potential inherent value to the asset because it makes it a much more financeable asset to the exit buyer. Most buyers are not like Cove Capital. Most buyers utilize debt, even in today's market. And so our goal is to make our asset very clean, very financeable. So when we go to exit this deal in the future, our buyer pool has a wide buyer pool. We don't want to have a property that has a bunch of unattractive lease structures or, that a bank might be looking at and not feel as comfortable. So, again, the nice thing with a landlord like us as a DST operator is we pre-capitalize those reserves so we have true capital to continue to invest in the assets and continue to hopefully renew leases, the goal, the business plan. And so this was a relatively, newer type shopping center. It was built in 2007. A lot of the nuts and bolts are in good shape. We did negotiate some credits to repair roofs to get those up to par. But overall, the asset was in relatively very good shape and taken care of. There are a lot of supporting tenants in this corridor that either are part of our offering, and you can refer to the offering documents to see our tenant profile. But there are a lot of name brands that are either part of our offering and or share this kind of Eastwood Village Plaza. And these are tenants such as one of the highest performing Walmart Supercenters in the area, if not arguably in a very top performing location in the entire country. From our understanding, Walmart actually owns that piece of real estate. It's very potentially important to them. We got other tenants such as Chick-Fil-A, Starbucks, Wells Fargo, Walgreens, regional banks, Pep Boys, PNC Bank, Waffle House, and many more in this corridor. And some of those are part of our offering, some are not, as I mentioned earlier. Over 78,000 vehicles, according to data, pass by the center. We're off the Interstate I-20 and Crestwood Boulevard, which is, if you were from that area, major arteries. The center itself, from a lot of research and data that we can, in today's world, through technology and sourcing, we are seeing customers as far out as a 15-mile radius in the greater Birmingham MSA visit this center. There's some unique opportunities, as I mentioned, of getting that rent increase just naturally, even through the current leases. I mean, we have one lease currently that's paying under market rent, a little over $6, and in 2025, it's going to be at $10. Assuming this tenant stays in business, which we believe that tenant would. We had a brand new Amazon distribution facility right behind. We do not own that. It's not part of the facility, but it shows the growth in the Birmingham. It's a brand new Amazon logistics distribution center that added over 1,500 jobs to the market. You'll see a picture in the background, state of the art. So these are things we like to see in a market, especially when you're dealing with retail. And this is any property. You go back to the old saying, location, location, location. So what is important to the asset class that you might be doing, and tie it back to location, location, location. There have been certain retailers out there or retail properties that have gotten a bad rap, but when you go back to the old school real estate of location, 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 and you realize, oh yes, that person might have bought a Dollar General or a Family Dollar in the middle of nowhere, that's not location, location, location. That was, I got convinced by a real estate broker to buy a credit of a lease to get maybe a higher cap rate. And so, we constantly, and again, there are no guarantees, but we believe by having that location factor tied into whatever the asset class or type of property or tenant, that it's important, that it's strategic, that it's replaceable. If that tenant were to leave the location, is it replaceable in an appropriate amount of time? And we feel that at a center like this that's 96+% occupied and has maintained a historical occupancy at that level, that our tenants are replaceable. If we were to lose a tenant, we feel our team would have a very likelihood of replacing that. And not to mention, again, we are debt-free. We have staying power to absorb those types of potential changes. And so diving into the next offering, which is Cove Rogers Business Park Opportunity 73, very similar in terms of business plan of Eastwood, in terms of we want to get in there, get our hands dirty with the tenants, and maintain relationship and increase rents. A lot of what we feel from a market research standpoint and other similar properties in this location, this is a property in a submarket of Houston, Texas, Fulshire, which this particular submarket is one of the wealthiest, or part of one of the wealthiest counties in Texas, which is Fort Bend County. Within a 3-mile radius of our property, there's an average household income of almost $200,000, which is, for a Texas, pretty high. If you look at the percentage above Houston for those stats, the actual, dead center Houston, we're 83% above that. And so this is a very, kind of arguably higher end submarket of the Houston, Texas market. In here, we feel there is a stabilized value add. This was a newer construction property. I believe, don't mark my words, I believe it was constructed in 2021, approximately. So a lot of these tenants have, more recently in the recent years moved into the location. In all of our tenant interviews so far, tenants have loved the location. It is obviously newer construction, as you'll see, very presentable to a customer as they drive into this business park. Business parks are unique, and we've done a handful of stuff like this where you can have a mix of tenants. Something like Eastwood Village, that's going to be, a lot of larger corporate tenants with maybe some, local tenants on the inline, but it's primarily retail, where something like the Cove Rogers Business Park, it's very similar to the business park that we hold our headquarters here in California. It is flexible in terms of the types of tenants you can get in there, and that's nice. Again, we always want to look at the downside risk protection. This is a debt-free offering as well, but if we lose a tenant, who are our tenants as options to replace? And something like the Cove Rogers Business Park, you have retail, you have restaurant related, you have cafes, you have actual businesses, you have flex space. If you look at this property, you'll notice there's kind of industrial flex, small, warehouse approach. So you have a wide range. There's almost 100,000 square feet of mixed-use retail industrial at this property. It is 99% leased as of today. And as I mentioned, we have local retail, service retail, industrial tenants, very diverse mix, staggering leases. If you look at the market rents, and there's a couple Class A retail centers that are also being developed in this market within our vicinity, so arguably, and those rents are going for $23 to $25 a square foot. Our average number is approximately, for our retail related clients, a little over $17. So we feel we have room to increase rents. We also have room to keep our tenants, because if our tenants were looking to leave and move to another spot, they're going to be significantly increasing their overhead. And in a market like today, in the coming years, as a business owner, you're going to be cognizant of that. And this is already a very well located property in a well located thoroughfare. And then you look at the industrial rents, because as I mentioned, we have a mixed use asset. And so we're looking at the different types of tenants here. You look at the industrial rents, usually around $17 to $20 a square foot in this market from what we're seeing. The average rents, I apologize, the average rents in the market are around $19. Ours, there's some tenants as low as $17. So there's a little room for growth there. And I think, again, as you have this kind of flexible asset of types of users, it insulates us for the downside protection. And yes, we can lose tenants in anything, any property, any piece of real estate out there. Everybody knows you could have vacancy. But what we're looking for is markets that have low vacancies in the submarket, and that checks the box on both of these assets. Then we look at the direct asset and look at the historical occupancy. And, Eastwood Village has always had high historical occupancy at the 96+% on average. And the Full Shire, newer building, as I mentioned, 2021 construction, but it had a fast lease up. Whenever you build a brand new building, that's the thing you kind of look at is what was the demand for the location. And so we're really excited for both of those assets because we feel that there is some meat on the bone, some potential value, but from a stabilized approach. We're not buying necessarily a 50% occupied or a 60% occupied center that we're, promising the moon to bring it up to 100% occupancy. We are bringing a stabilized approach that gives us opportunity over the next 3 to 5 years to increase rents, control expenses, improve the tenant base, and hopefully have a very healthy outcome for our investors. But most importantly, having that staying power to protect the investors from a lender issue. And so now we jump, and I know we're getting close on time here, so if anybody has questions on those two DSTs, those two debt-free DSTs, please feel free to reach out to myself or anybody on the K Property side. We can dive into those deeper, and or we always welcome property tours as well. We have a great team that can meet you at any asset. And so now we are going to dive into the third opportunity on our platform. And this opportunity, as we mentioned earlier, is a cash investment, meaning you can't do a 1031 exchange, but we have thousands of current investors at K Properties, and from time to time, everybody's situation is different. But when they have capital, fresh capital after tax dollars that they're looking for a potential place to invest, we do have opportunities for that. For cash investments, it's very important. There's a lot of stuff out there in the real estate world through various crowdfunding platforms, stuff you hear on the radio, and the internet, whatever it may be. But cash investments, you really want to understand what is your protection when you invest. And again, we have different structures. We have some cash investment funds that are same as our DSTs, debt-free. That's how we're potentially insulating, protecting our investors. There's always cash flow risk, but protecting that initial investment, especially an after-tax dollar investment. I see investors get sucked into kind of the shiny new car on the lot where there's high IRRs being quoted on a website and it's a development deal. But a lot of investors don't realize that inherent risk that they're taking, investing that cash investment into something that might be very highly leveraged or very speculative. And so we have, if this particular cash investment isn't of interest of you, we have different kind of layers, different types of approaches. But the one I'm going to discuss today lightly is REBA RE Gain Fund LLC. And this is a senior preferred equity offering. And so what I mean by that is this is an existing portfolio of real estate, well over 20 assets. I believe there are close to 24 assets, plus or minus, and continuing to potentially acquire and absorb future assets during this whole time. But I bring that up because some real estate cash investment funds don't have any assets day one. They're raising capital from investors to go execute a particular business plan, and that could be acquiring real estate, and it could be successful. I'm not saying those are bad, but this offering, day one, has a very large portfolio of cash flowing assets. And so I'm going to give you estimated numbers right now, but these are all in the actual PPM, more detailed. But for the sake of the call, there is, after all expenses of the current portfolio, there is a over $14 million of positive net operating income that's coming from this portfolio. And so day one, as investors come into this portfolio, there is free cash flow. There's not a huge strategy that has to take place to create the free cash flow. Now, cash flow can always go up and down, but that's a big chunk of cash flow. Day one, from all the assets in this portfolio are currently cash flow positive. And so what this RE Gain Fund, this preferred equity fund, was created for was to enhance that current portfolio and enhance future acquisitions. Because as I mentioned when I was talking about the DSTs, real estate is a living, breathing asset. You need to invest to get a return, and you know, not all real estate is just going to stay Class A by itself forever. You never want to become a zombie building. You have to take care of your tenants. You have to be known as the landlord with all the leasing brokers out there, that you have capital to continue to service the needs of a particular tenant. So this portfolio, there's almost 2 million square feet of existing properties, primarily in the Southeast, so states like Florida, Virginia, Georgia, South Carolina, North Carolina, and that's really their target is the Southeast. Doesn't mean there's not an asset somewhere else that is acquired. It is everybody's tax situation is different, but there is some potential tax efficiencies within this structure. I forgot to mention, as a cash investment into this, the current distribution rate is 9.25%. And that's important to understand, because when you multiply the 9.25 times the $50 million that's being raised, that comes out, off the top of my head, somewhere around $4.6 million of income that has to be paid to these preferred equity owners, or these types, you as a cash investor. And so, as I mentioned earlier, there is currently a free cash flow after all operating expenses of over $14 million. And so your cash flow is ahead in the capital stack, so to speak, ahead of any other investor. So that $14 million would have to shrink all the way down below that, approximately $4.6 million before the distribution would affect or be affected to you as a cash investor. And then the $50 million they are raising is also ahead. The principal, the actual cash being invested in this portfolio is ahead. So at a future date, when there's a liquidity event, the first $50 million has to be paid back to the cash investors before any of the other existing investors in the other class of shares, previous owners that were in this fund prior to this preferred equity offering being created, get paid. And so again, not to repeat myself, as a cash investor, your cash flow is ahead of anybody else in the portfolio, and you have a good coverage ratio. Not to say that it couldn't drop, but that'd be a pretty significant drop. And then your principal investment is ahead of the any other investor, and there's well over, I think, in today's valuation, which if you go get real estate valued in today's world, we all know that real estate across the board, regardless of your asset class, has dropped in value, and also depending upon where you're at. And so even in today's valuation, which REVA went and did a valuation, third-party valuations in December of this year after all the rate hikes, and there was still well over, I think it was approximately well over $120 million of equity ahead of the $50 million. So you have that protection there. And so, what are they going to do with the $50 million? As I mentioned, they may, if a distress situation comes up with other assets, they may have opportunity to buy additional properties. But really, the goal with the money is to improve the current portfolio, to renew leases, to keep the curb appeal. When you're leasing, the most important thing is curb appeal. When I could say firsthand, when we were looking at buildings to move our 35 to 40 different employees and people who work for us, we take into account curb appeal for our clients coming in the office. We want a good environment for our employees, and we want a good environment for our clients. And so living, breathing real estate again, got to keep that curb appeal. So, getting in there, improving properties, even Class A properties, tenant improvement allowances and leasing commissions. That's a big one when you're leasing commercial real estate. You got to pay to get a tenant. Unfortunately, that's the way it works. But there's a return on your investment. So as an example, there was recently 4,500 square feet that was leased in one of the properties in this portfolio, or that's actively being leased as we speak. And the TI cost, the tenant improvement cost, was going to be approximately $195,000. So, in theory, that would come from the $50 million being raised. The rental income, though, that would be produced from the life of this lease that is being signed with this tenant is almost $740,000. And so, given that once the lease moves in and you start creating that, you look at the return. And so you invested $195,000 to yield after you back out that $195,000 to yield over $660,000 in return. That means you, in theory, made over 300% on your money that you invested into the property to get that return, to get that tenant. So that might be confusing over the phone. If anybody needs clarity on that, definitely set up a call. But I just wanted to give a little bit of example of, as you invest money in a property, you're always looking at that return on your investment. Be the same thing if you were, someone moved out of your single-family house or your multifamily, and you go in and instead of carpet, you put your hardwood floor. Instead of the old appliances, you put the shiny new appliances. Maybe you add a dishwasher that didn't exist before, and add marble countertops. And you might spend $15,000, $20,000, but over the next 5 years, you're easily going to make that up because you were able to increase your rent significantly for that new future tenant. Again, this is something that does have a lot of detail to it. I would highly suggest setting up a call with myself. This is Chay Lapin. Even if you're working with anybody else on our team, I do know this portfolio very intimately. As full disclosure, we made a cash investment into this ourselves with our own family money. Again, this may or may not be right for everybody, but if you do have interest in this REVA, RE Gain Fund, 9.25 current distribution, senior preferred structure, meaning, again, the protection of the potential cash flow ahead of other investors in there, and senior preferred in the capital stack of that $50 million being protected by the existing real estate over 1.9 million square feet. So I know that was a lot. We really appreciate everybody spending time with us on calls like this. We are big on education. We are big on telling you the pros and cons. Reach out to us. We'd love to dig into if there's other offerings out there that might make more sense for you, to dig into those and kind of do the exercise I just did on this phone. So Keith, we appreciate it, you hosting this, and we hope everybody has a great weekend coming up here.
Awesome. Thank you for your time today, Chay. And once again, we do urge our listeners to reach out to their K Properties representatives to request the PPMs for the 2 multi-tenant DST offerings, as well as the cash offering available. So please log in to the K Properties Marketplace at www.kpi1031.com to view 20 to 40 DST offerings from over 25 different DST sponsors, or call K Properties at 855-899-4597. That's 855-899-4597 to speak with a licensed K representative who can walk you through some investment options. Thank you again, Chay, and join us next time for DST Essentials with K Properties, an in-depth look at the various aspects of the DST 1031 exchange investment process. Thank you all and have a great weekend.